Good evening, everyone. Welcome back to You and Your Health. We are excited to have you join our program this evening. My name is Erika Roberts, a co host of this program, and my other co host is Dr. Edward Bisman. Hi, Dr. Eddie.
Hi, hi,
How are you?
Rekwa. How are you? I'm good.
I'm good. And you?
Yeah, I wanted to be the first to ask how you were doing, but anyway, women first. So,
Oh, thank you, thank you, thank you. Are you looking
yeah,
forward to Easter or
yeah,
this
we
coming
have a lot of
Sunday?
programs lined up at church. So, the flyers will be circulating, and people should stick or to get glued to their YouTubes and Facebook to watch the singing band perform Saturday, this coming Saturday.
Okay. I'm sure that'll
Mm,
be an exciting program
yeah.
for people to watch. Okay, so we have a very, very interesting topic. So we're gonna go right ahead and get started this evening. As I mentioned a couple of weeks ago, our program for the past 2 months has been tailored towards the 9 dimensions of health, and financial health is a huge component of that. One's financial status truly affect their overall well-being. Your financial status could induce stress, which can turn into illness along with depression, so on and so forth. So planning financially will not only help you maintain the lifestyle you want, but it will decrease your stress level and possible illnesses as well. So I can't even imagine those who have been laid off from their jobs or have decreased hours during this pandemic. But we pray that God restores whatever you have lost during this pandemic, particularly your finances. So, luckily, we have one of the experts in the area, Mr. Jamal Hilton, to talk to us about how we can improve on our financial health. We will touch on different phases of life, someone who just started out in the workforce, someone who's mid career, and those of you who may be ready for retirement. But before we get started, we want to thank our last guest, lawyer Ikua Boachi, for her discussion on immigration and updates. We should be the updates that we should be looking for. I know that it was a short discussion because of some time constraints that she had, so we hope to bring her back another time to expand on the discussion. But if you are interested, that discussion is on the church's Facebook platform. So please tune into that as well. As I mentioned this evening, we have Mr. Hilton, a financial advisor with Blue Mountain Financial Group. He has over 10 years of experience and has worked with several financial firms in the area. Since we're expecting a lot of participation, I will just go ahead and tell you a little bit about him, and then we can get right into our discussion this evening. So, Mr. Jamal Hilton, our financial advisor for this evening discussion, is a graduate of Old Dominion University in Virginia with a Bachelor's of Science in Business Administration with a focus in finance. He ventured into his career in 2009, where he entered into the banking sector and financial services industry as well. Mr. Hilton, as I indicated, has over 10 years of industry experience, specializing in wealth preservation strategies, as well as business continuation and key employee planning in retirement design. Mr. Hilton's goal is to assist families, individuals, and small business owners in achieving a higher level of financial independence and security through holistic and comprehensive solutions. Throughout his career, he has demonstrated the skills, knowledge, and experience required to help his clients meet their unique needs and goals. So let us welcome Mr. Jamal Hilton to our program.
Hello.
Hi, Mr. Hilton. Thank you for accepting our invitation again to be on our program, particularly for this segment. So, before we get started, I have a question for you. Not how, but how did you decide to work in the financial sector or to become a financial advisor, I should say?
So thank you again for your invitation and thank you for that introduction. That was quite an introduction. I appreciate that. The reason why I actually got into the financial services industry actually goes back to childhood. So I grew up in New York City, inner city, and unfortunately, I saw a lot of poverty growing up, and I made the connection with what I saw with finances and what people know about finances and the financial decisions that they're able to make, and the situations that they're in. And I decided, you know what, I would like to learn about finance so I could make sure that moving forward, I won't be in a situation like that. And then in addition to that, I actually liked math all my life growing up, and I was always good with numbers. And so I also wanted to do something that involved numbers, and so financial services or financial advisor is the perfect combination of the two, where I'm able to help people with their finances to help them avoid, bad situations financially, and I also get to work with numbers. So that's the reason why I got into the field.
Okay, that's that's interesting.
Mm.
I know that you've worked with a lot of big name companies, which you were very modest with your bio, and you didn't mention it. So, do you mind telling our viewers some of the companies that you previously worked with?
Yeah, so out of college, the first company I worked with was Wachovia.
Hmm.
And as you know, Wachovia was taken over by Wells Fargo, so I was able to work with Wells Fargo as well as MetLife, and then Mass Mutual. Right now, I'm independent. I have my own practice, but I still broker with major institutions like Mass Mutual and Penn Mutual and others. So being independent, it allows me to actually provide clients with the best solution, regardless of the company's name.
Okay, so you actually do still have access to their products that they offer.
Absolutely. Yeah.
Okay, okay. So, Dr. Eddie, I know Dr. Eddie had an interesting question for you. So, Dr. Eddie.
Oh, Dr. Eddie.
Anyway, so when I chanced upon your name was like, okay, Jomo. So how is Mr. Hilton or Jomo Hilton related to Jomo Kenyatta of Kenya?
Yes, so good question. So my background is I'm Jamaican. Both my parents are Jamaican, but
Mhm.
my godfather actually named me, and he named me after Jomo Kenyatta. Jomo Kenyatta,
Okay.
believe it or not, was very popular in Jamaica, especially during the Pan African movement. And so
Really?
I guess my family saw me as a future president, and so I was named after Jomo Kenyatta.
Okay.
The future president of Jamaica, or future president of America, or which one?
All the above.
All the above.
Okay,
Okay,
well,
yeah.
Yeah.
okay. All right.
Okay. Well, we could get started in terms of our questions, and Dr. Eddie, please feel free to come back and post questions as well if our viewers
Yeah.
have any financial questions for
Okay.
Mr. Hilton to respond. So, as I indicated, we had discussed, the three of us had discussed about possibly you going over the different phases of life. So, someone who have started their career, perhaps just got out of college and had their first job, and also then looking at someone mid-career, how they can save, how can they can help their children, and then someone who's pre-retirement, planning that phase of their life. So perhaps you can start with the early career portion of it. So my first question is, what is the best way for someone who has started their career to budget?
Okay, good question. So, and I think it's very important to touch on these different topics and phases of life because while everybody's situation is different, we do have some commonalities between us, especially grouped by age, right? So, when you're first starting out, you have some similarities with people in your age group and so on. Now, specifically relating to budgeting is the most important thing when it comes to finance and it's sort of the foundation. It's how much money do you have coming in, right? Because we all have limited resources coming in, whether you work a salary or you own your own company, you have a fixed amount of money that comes in, and then what do you do with that money going out, right? And so budgeting is really important. So one of the things you want to think about is treat yourself as you would a business. And so just like a business, you want to be profitable in your own finances, you want to be profitable as well, meaning you have more coming in than what you have going out. That's the absolute basic. So first step is take an account of all your income sources, take account of all your expenses, and make sure that your income sources is greater than your expenses. Then once you have that in place, then you could figure out, okay, what percentage should I allocate towards each expense? Okay. And so just a general reference or general frame for you would be your housing, so how much you pay on whether it be rent, mortgage, but the place you live, you do not want that to take up more than 35% of your salary, of the income that you have bringing in. And then when it comes to next transportation, you don't want that to be more than 15%. Savings, you want to be able to save at least 10% of your salary. Then you have debt. So debt, you don't want that to be more than 15% of your salary. And then the remaining 25% that should go towards your overall um, everything else. So travel, what have you. And so that's a good frame of mind to keep in place where, how much of my fixed money that I'm coming in am I spending on these different areas? And so it's important to have that in place.
So not necessarily the gross income, is the income after taxes that you bring
Right.
in is what you, okay.
Absolutely. Because, the gross, you have social security and things taken out of that, which you can't control. And so now after that, what are you left to spend?
Okay. Okay. So my next question is, when should they start investing and saving for retirement?
Another good question. So the earlier, the better is the rule of thumb when it comes for saving for retirement, and especially the earlier you plan to retire. So if you want to retire when you're 50 or 60, you're going to have to save more faster than if you plan on retiring at, let's say, 70 or 80. But the earlier, the better, and the reason being is that your money grows by compounding, and compounding means that the money that you've saved earns money itself. So your money actually works for you, and the longer time you have for your money to work for you, the faster it will compound. And so by beginning early, that allows you to save enough for retirement with putting actually less dollar amount in. So, for example, I had a client that's in their 50s, haven't saved anything, wants to retire at 60. And they asked me, okay, if I want to retire with $1 million, how much should I put into my account? And when I told them the amount that they need to save each month, it was a very high number. They almost got, a little bit of shock from that, right? But that's because they're 50 and they're saving for 10 years to save $1 million. You can imagine you don't have compounding working for you at that point. But let's say if they were 25 and they came to me and say, okay, I would like to have $1 million by the time I retire, that number that they're going to have to save each month is going to be a lot lower. It's going to be reasonable. It's going to be something that they could save and it won't hurt their pockets at all because they're going to have compounding to help them with that. So the
Okay.
earlier, the better.
Okay, so you had mentioned initially that you need to put away 10% of your salary, right?
Mhm.
So is that 10% included in savings as well as perhaps 401k, IRAs, all combined as 10%, or you need that 10% in one bucket?
Great question. So typically that 10% at minimum is for retirement savings. Okay. And so outside of retirement savings, you need to save more than that. But the great point of that is it doesn't all have to go in the same place, your total savings. So let's say if your total saving is 15% of your salary, okay? So out of that 15% of your salary into your retirement plan, you want to put in at least, if you're working for a major company that matches your contributions, you want to put at least at minimum that amount that they're matching for the contribution. So, for example, a lot of folks in this area is government employees, right? And so the government may match their salary of 5%. So they want to make sure that they're actually contributing 5% because that's free money that they're getting from their company match. And then in addition to that, you could pick different places to save depending on your situation. So, for example, if you're just starting out and you don't have any emergency savings in place, then you want to first build up your emergency savings. And then after you build up your emergency savings, then you could start focusing your savings in other areas that's a little bit more long term.
So, how much emergency savings should one actually save? You hear that term all the time. So, what?
Right. Yes, so emergency savings, it depends on somebody's situation. So let's say if somebody's a government employee where their job is pretty secure versus somebody that is self-employed where the job is not secured at all, right? It could go at any time. That kind of depends, that kind of will change the amount that you should have in your emergency savings. But a good general rule of thumb is no matter what industry you're in, no minimum less than 3 months of emergency savings to 6 months of emergency savings. And when I say months, I'm talking about expenses. So let's say, for example, your expenses is 25, then you want to have at least 7,500 in emergency savings. And so you could do it at a rule of thumb based on your expenses. Let's say if your expenses is 4,000 a month, then you want to have closer to 12,000 in emergency savings at minimum. So anywhere from 3 months to 6 months. And then from there, once you already have your emergency savings in place, and you were able to put more money away, you could put that money into other areas that's going to be a little bit longer term, and those areas are actually going to make you money. So that's when it starts getting exciting because then your savings could actually make you money.
So, do they need life insurance, particularly outside of their job? Because most jobs may provide life insurance. So, do you mind expanding on that, whether they need it at their job and outside their job?
Yes. So with the life insurance that's provided you through your employer, typically you'll get at least one time or two times your salary at no cost. So that's great. There's nothing you have to do about that. But that being said, that coverage lasts as long as your employment lasts. And so you could change jobs, you could retire, you could be let go. And once that happened, that coverage goes away. So it's actually important for you to have coverage outside of that employment. And also, reason being is that once we age, our health changes as well. And so, because of those health changes, you may not always be insurable. And what I've seen all the time is that later in life, when folks decide, you know what, life insurance is something that I really need and something that I really want. Unfortunately, they've had health conditions already, whether it be, cancer or other things, heart, major heart failure and stuff like that. And unfortunately, at that point, it's very difficult for them to get insurance. And so I always say, you want to lock in your insurance now because we don't know what the future holds. And also, the younger you are, the less you pay for insurance. So there's two benefits of starting early. One, you know your health now because we don't know what our health will be tomorrow. And two, we're not going to get any younger. We're only getting older. So it's only going to get more expensive the longer you wait.
Okay, that's very good information. So, how do they protect their income? Like, for someone
Great.
who's just starting off their career.
Great question. So, a lot of times when I'm talking to clients and I want them to just have a good frame of reference, I'll ask them, what do you consider be your greatest asset? And a lot of times folks may say their home may be valued 200,000, 300,000, 400,000, etc. Or they may say their retirement account's at 300,000, or they may say, this asset or that asset. And then I say, well, how much do you make a year? And they may say, I make $100,000 a year. Okay, how many years you plan on working? They may say, I'm going to work at least 10 more years. Okay, $100,000 a year times 10 years, that's $1 million. So you have $1 million of earning ability. I would say that's your greatest asset. That represents the greatest amount of money that's going to come into your estate over, your lifetime is your earning ability. And oftentimes people will insure their car that's worth maybe 20, 30, 50,000. They may even insure their cell phone that's worth, $1,000, right? You may have insurance for your cell phone, but they won't insure their biggest asset, which is their actual earning ability. And so protecting your income is extremely important because if your income stops, none of the other things that we discussed matters. If you have no money coming in, you're not going to be able to save for retirement. You're not going to be able to travel. Pretty much the buck stops there. And so you want to make sure that no matter what happens, right? Whether you get injured, you get sick, that you will still have income coming in, because that allows everything else to happen.
Okay. All right. Do you mind giving examples of how you protect your income?
Great. Yeah, I definitely can. So some employers, not all, but some employers will actually allow you to protect a percentage of your salary. And they call it disability, and they call it long-term disability. The short-term disability could kick in for a couple days or weeks, and then long-term disability kicks in after the short-term disability expires, and the long-term disability will last anywhere from, I've seen, 5 years to retirement. It really depends on the employer. And then it will also typically cover about 60% of your salary. So again, just to keep it simple, let's say if your salary is $100,000, 60% of that will be $60,000. So you would then get $60,000 if you were to be sick or injured, and then that 60,000 you would have to pay taxes on. So that's the first way that most people are protect their income, is through their work, long-term and short-term disability. Now, I'm sorry. In addition to that, they will get additional insurance on the side, because a lot of times 60% of their salary, then taxed at, let's say, 22% tax rate. Once they finally get that paycheck in their hands, that's not enough to cover everything. And so they will get additional insurance on top of that to make sure that if anything were to happen to them, that they will be able to at least cover the basics, like housing, food, travel, things of that nature.
Okay. That was my other question as to whether they should get one outside of the employment.
I said
Dr.
we
Eddie,
don't.
let me ask Dr. Eddie whether we have any questions before we move forward to
Um,
mid-career.
yeah, there's no question here,
There's no
so you
question.
can. I mean, we are all enjoying the discussion, so you can.
Okay. All right. So let's discuss mid-career. So how should folks who have children, in their mid-career, plan for their children education? How should they save for their children's
Yeah,
education?
great question. So, and this question involves many different parts. But there's a couple different education costs. So you have, education costs that could be before college, and then you have education costs that could be college and beyond college. So you do have some parents out there that wants to send their children to private school, and then you have parents that also wants to send their children to a college, and provides part or all of their education costs. Now, depending on the state that you live in, each state has their own in-state education plan. And generally, how those plans work is that you're able to contribute money into that plan. That money then grows tax deferred. And if you use those money specifically for educational expenses, you're able to use it tax free. So what that means is, if you put in, just to keep it simple, $100 into this plan, and that plan grows to $1,000, then you have $900 of gains into that account. And if it's used specifically for education, that $900 in gains, you're actually able to spend tax free. So you were able to grow from 100 to 1,000 and not have to pay any taxes. That's generally how most of these plans work. But depending on the state that you live in, each state has different limits with how much you could contribute to it and what it could be used for. So, speaking on something that's generally allowed in all states is the what's called the 529 plan, 529. Now,
Yeah.
the 529 plan actually allows each parent to contribute 15,000 into this plan. And again, that 15,000 could grow to 100,000. And if that money is used for education costs, then you get to spend it all tax free. Now, the 529 is primarily used for what they consider higher education, so college. where it could 100% be used for college. But let's say if you want to use some of it before your kid gets to college, you can. It actually allows you to use, I believe it's 10,000 a year towards elementary school, middle school, as well as high school, for the parents that have children in private school. In addition to 529 plans, you can actually save for college in other areas. So, for example, parents would sometimes get life insurance policies that grow cash value, because those cash values could be used for educational purposes tax free. And then it's also not included in the FAFSA form, which is a form that parents complete with letting the colleges know where their assets are positioned and how much they're going to be getting in Pels, grants, loans, and things of that nature.
Okay, so I have two questions based on your response. You'd mentioned that a parent could contribute 15,000. Is that 15,000 for the lifespan of that program, or just 50,000 yearly, or
Oh, yeah, great question. So that's 15,000 per year,
per year?
each parent, and also in addition to that, grandparents could contribute as well. And oftentimes, sometimes that's where the bulk of the monies will come from in 529 plan is grandparents.
Okay. So, and then you had mentioned life insurance that has cash value. Is that whole life or
Yeah, yeah. So
term
the
or?
two main types of life insurance that carries cash value, well, three would be whole life would be the most popular, and then you have variable universal life that works similar to a whole life, except for the instead of the cash earning dividends, the cash is actually invested in the stock market. And then you have universal life, or sometimes they have another initial in front of the universal life, but UL. And the main difference is oftentimes that cash value earns a specific amount of interest. But in all three cases, those policies grow the cash value, and you could use that cash value on a tax favored basis for education or for anything else. Part of the concerns that parents have with 529 plans is that they are limited in scope, meaning if the monies is not used for education, then it's actually taxed. And so they may feel, well, I don't want to put everything in a 529 because what if my child gets a scholarship? What if they don't need the money? Then this money is kind of trapped or it's taxed. And so oftentimes what they may do is they may put a percentage in a 529 and then put another percentage, let's say in a cash value life insurance policy that they could use for any purpose, whether it be wedding, or something else. It's not limited to just education.
Okay. So, my next question is whether it's advisable for someone who's mid-career to help their children's tuition. So, someone who perhaps did not save, right?
Hmm.
And they're like almost 45, 50, or 55, mid-career,
Yeah.
thinking about retirement 10, 15, 20 years from now. Should they be contributing to their children's tuition, or should they be saving for their own retirement?
Yes. So this is a great question, and unfortunately, I see it all the times where especially folks in their mid-career, they're kind of stuck in a hard place because sometimes they'll have children and they'll also have aging parents, and they'll want
Mm,
to take care of both. They want to take care of their children, they want to take care of their aging parents, and then they also want to save for their retirement, right? And we know there's fixed amount of resources, there's fixed amount of income coming in, so you can't do everything. You have to pick and choose, and you have to prioritize what's the most important. So that being said, I would say when it comes to education, while this is not ideal, you can get a loan for education. You can borrow for education. You cannot borrow for your retirement.
mm.
And so, while it's in our, interest, and while we would want to make sure if there's money's there to take care of our children's education, it should not come at an expense of your own retirement picture.
Okay. Okay. That's a hard one to pick.
It is.
And should they put their money in health savings account? HSA, those in mid-career.
Yeah, so this is an account that's becoming even more and more popular. You're seeing more and more companies offering their employees health savings accounts. And reason being is because as we saw over the last 20 years, healthcare costs has continued to grow. And so the cost for your health insurance has also continued to grow as well. And most, whether it be HMO or, different type of POS health plans, typically you have high premiums that you have to pay every month. And so what they've offered employees is the option of having a health plan that have a low premium but very high deductible. Okay. And so that's particularly good for folks that don't go to the doctor but once a year for their annual checkup, right? So you only go once a year and you're paying all this money a month. Is it's like, does that make any sense? Well, for those type of folks that don't have to go regularly or the high deductible health plan allows them to pay a lower premium, and the difference what they would pay into that higher premium plan they could actually put that in the health savings account. So let's say, for example, and I'm just kind of making numbers to paint an example. Let's say a regular insurance plan will cost you $500 a month. The high deductible plan may cost you, $250 a month.
Mm.
And so that extra 250, you could actually put in a health savings plan each year, each month, and that health savings plan will actually grow tax deferred, similar to our education plan. And if that money is used specifically for health expenses, you get to use that money plus any growth in that account tax free. And the great thing about a health savings plan, as opposed to a FSA or flexible spending account, is that the health saving plan, you don't have to use it or lose it. It actually rolls over every year. So let's say once you get into retirement, where healthcare costs is generally higher, you'll have this bucket of money to help with.
So does it stay with you even if you leave your employment?
Yes, it does. So you could actually take it and roll it into other health savings plan and continue to grow it and continue to grow it tax deferred.
Is there a
Absolutely.
limit to how much you can have in it
There's not a limit to how much you can have in it, but there is a limit to how much you can contribute each
per year?
year per year. And that limit typically grows. I think it's around 2,400 now, maybe actually higher than that with the CARES Act that just passed, maybe closer to 3,000. But that limit increases every year with rise of cost in goods and services.
Okay. So my next question regarding mid-level career folks is it better for them to rent or to own a home at that stage of their life?
Yes, this is the age-old question, the rent versus buying. And there's people on both sides of this debate that gets very animated and they're like, no, this is the right way, this is the wrong way. I'm neither, folks. I'm in the middle. I will say it depends on the situation. It depends on what makes sense. If you're in a situation where buying a home, you're not buying the home for way above market value, and you're not buying the home at a very high interest rate, then it may make sense. But if you're in an environment where interest rates are high, you're going to pay a high interest rate, and home values are, too high, then it may not necessarily make sense to buy a home. It may make sense to rent and wait until it's a good buying opportunity. While your primary residence isn't typically seen as an investment, quote unquote. It's seen as the place that you live. I look at things because of my financial background. I look at things as an investment perspective, and even the home that I'm living in, I want to make sure that I'm getting a good deal, I'm getting a good value, and the numbers actually make sense. So the short answer to that is it actually depends on the situation, whether buying or renting is more advantageous.
Okay. Dr. Eddie's
Uh,
here, so I'm sure he
yeah,
might
can
have
I
questions.
can I take you back to the short and long term disability insurance that you mentioned? Is that only employer based?
No, no. So the majority of short-term and long-term disability is going to be through your employer, but you can have insurance outside of that that's not employer related at all. So I will use myself as an example. I have short term, long term disability um, through my company, but in addition to that, I have a private plan that I've purchased, um, individually myself outside of that to make sure that if knock on wood, anything were to happen to me, I have enough income coming in that's going to at least meet my basic needs, right? So I may not necessarily be able to live exactly the same lifestyle that I was able to live before, but I will be able to at least maintain a certain minimum. So while the majority of the coverages that people have for short term and long term disability come from your employer, it's not exclusive to your employer. You could actually get insurance through private companies. So I'll just name a few, for example. So Mass Mutual, Protective Life, Prudential, just a short list of different companies that I've able to write Mutual of Omaha, just different companies that I'm able to write disability coverage on folks um, for disability. And in addition to that, especially high earners. So the disability that you get to your employer, while it may be a percentage of your salary, 60% or whatever have you, in addition to that, it may also have another cap where it's just, a dollar amount cap where it may say only going to cover 5,000 per month cap, regardless of what your salary is, or 10,000 a month cap, regardless of what your salary is. And so it's really, really important for you to go through the fine print of your benefits package to see what exactly is involved in your disability coverage, because every single employer, when it comes to disability, is different. And so look through the fine print and then decide, is that adequate coverage? If it's not, then you want to get something outside of that, and you could definitely reach out to me, and I'll get help you in that department.
So you will definitely advise someone mid-career to get long-term care
Uh,
insurance.
okay, so long-term care insurance. So it really depends on what's the projection of how much assets do you plan on having in retirement, and your situation. So long-term care insurance is the best way to protect your assets if you were to ever need, you know, care in your older age. And the reason being is because if you were ever needing to go into a long-term care facility, the cost of those facilities are astronomical. Talk to friends about this. Some friends of mine who parents are, high in age, and they're debating whether or not the parents will go in long-term care facility, and they're looking at the cost, and you're looking at, could be $300 a day, and you
Mm,
start doing the math
expensive.
on that, even if you have a good amount saved up, it could wipe that out really, really fast. And so long-term care insurance is a stopgap to protect from those situations where if you do need to go into a facility or need somebody to come into the home to provide care, um, then that type of care could really wipe out your assets. But if you have insurance in place, it will cover that. But because the cost of benefit is so high, those types of insurance is not cheap. And so I would say it depends on somebody's situation. If you're in a situation where you could say you're a high earner or mid to high earner, let's say if you're, upper, middle class or upper middle class and above, then it may make sense. If you're, you don't earn a lot and you don't have a lot saved up, it may not make sense for you because there's not as much assets to protect. And then push come to shove, while Medicare doesn't cover those type of expenses, Medicaid does. And so
Mm.
if you're in a situation where you're, don't have a lot of resources at all, the state will actually provide with care. You just have to be below a certain amount of assets in place to qualify for Medicaid. But Medicaid will kick in if if you're in that situation. Now, the downside of that is if the state is providing the care, the state will tell you the type of care you're going to get, right? So let's say if you're in the state of Maryland, they could say we're going to put you in any facility in the state of
Mm,
Maryland. It could be close to your loved ones. It could be next to the Pennsylvania border, right?
mm.
So that's one of the disadvantages of Medicaid. But if you're providing the care for yourself, the cost could be very high, and so oftentimes you want to have insurance in place. And long-term care, most employers do not cover long-term care. And so I want to make sure I want to specify. So we have short-term disability, long-term disability, and then separate than that, you have long-term care. And most employers do not cover for long-term care. So that's something you have to get on
Outside
your
of,
own, outside of your employer. Yeah.
okay. So I'm curious about this. For those of us who are godparents, like what is the best way to help a godchild out with college expenses in terms of savings towards that goal?
Yeah. So, with the godchildren, you could put it in a college saving plan, but the only thing is, again, it becomes very limited in what you could use it for. It has to be used for education. Now, one of the advantages of like the 529 is that you can change the beneficiary of that account. So let's say if you was earmarked for one godchild, but that godchild got a scholarship and doesn't need it, you could actually then change the beneficiary to be another godchild or your own child or own relative. So that's one of the
Okay.
advantages of 529 plans is that you could change the account, the beneficiary of the account.
Could
But
it be split?
it could be split. Yeah,
Okay.
it could be split. Now, outside of that, if you're saving, want to help godchildren with savings, me personally, with college savings, I will personally put that money into my um, own account and have them maybe listed as beneficiary. So I'll set up just a individual brokerage account, have them listed as beneficiary, and so that way I can control it. If it's not used for education, that's
Could use for
okay.
other things
The
too.
other things, and then God forbid if anything were to happen to me, it will pass on to them.
Okay. All right. Good answer. Dr. Eddie, do you have any other questions for mid-career before we move to pre-retirement?
Yeah, I think it was a follow-up question to the first
Okay.
one, but he exhausted the answer.
I
So
think you might have
looking
answered
up
that.
to more.
So
Yeah.
then,
Yeah. So so yeah, so through your employer, more than likely they'll automatically enroll you in short-term and long-term disability, but do not take that for every employer because I have seen where it's offered at no cost, but it's not automatically enrolled, and so folks think they have it, and unfortunately something happens and they realize they don't have it. And so you want to make sure that you know exactly what's included in your work long term and short term disability, and then two that you're actually enrolled in it. And then you want to look at the numbers and say, you know what, based on the numbers, is this enough coverage for me? If not, then you 100% want to get coverage outside of your employer. In addition to that, to make sure that you are adequately covered for your expenses because it's based on your situation. So most folks, does it make sense for them to have disability coverage outside of the employer? I would say yes for most folks, but not everybody.
okay. All right, let's move on to pre-retirement before we run out of time here.
Okay.
So, how much would you suggest the folks would need to retire?
Great question. So this depends, and this is one of those situations where I'll have to say, everyone that's listening or watching, if you have this specific question, let's have a one-off conversation because it really depends on what age you're going to retire, family history, how long did your parents live or are living, and also where you're going to retire, right? Because if you're retiring in the Maryland, D.C., Virginia area, you're going to have a lot different expenses than you would have if, let's say, you retired in Florida or other areas where cost of living is lower. And then also, what type of lifestyle do you plan on living in retirement? So how much should you have in saved in retirement really depends. So for one person, it may be they only need 500,000, or another person they may need $2 million. It really depends on the lifestyle. Now, what I can say is the easiest way to maximize your retirement savings without having to put a penny more into your retirement savings is to go into retirement healthy. That's the easiest way to maximize your retirement savings because by far one of the largest expenses you will have in retirement is healthcare costs. And if you're going to retire healthy, then more than likely you may have lower healthcare costs. And so the monies you do have saved up will go farther. So it's possible going to retirement healthy, you'll have more money to spend in retirement. All
Okay.
the things you want to
So,
spend it on.
so where should your income come from in retirement?
Yes, another great question. So when you retire, you more than likely, unfortunately for folks, we do not have pension plans in place. Some folks still have pension plans where their employer is going to guarantee them an X dollar amount every month, no matter how long they live. And so there that becomes something that they could rely on. But unfortunately, most folks now, we do not have what's called a defined benefit plan, which is a pension, where the amount that you're going to get every month is defined. We now have what's called defined contribution plans, which is your TSP, your 401k, your IRA, where the amount you can contribute every year is defined, but how much you're going to have at the point of retirement is anybody guess. Depends on what the market does, depends on what you're invested in, depends on what you contribute to it. Okay. So now you have an asset, right? And then you may have Social Security, but that Social Security is not going to be enough to cover your expenses. And so now that asset has to make up the difference between Social Security doesn't cover. And so you have to now turn that asset into income. And this is a very, very, very tricky part. And this is the part that some folks gets wrong. And unfortunately, this will hurt their retirement picture. So one thing, rule of thumb is you want to have enough income to cover your basic expenses in retirement. So when I say basic expenses, I mean literally the basics. Do you have a mortgage? Does it cover your mortgage? If you don't have a mortgage, does it cover at least the utilities? Does it cover, food, gas? Not travel, not vacation, not the extra stuff, but the basics. You want to have guaranteed income to cover your guaranteed expenses. Okay. And then in addition to that, let's say if you have additional monies or additional assets, those then could be used to cover your vacation, your travel, your golf, your, whatever have you. Um, but you want to make sure the basics is covered. And so you need to turn your asset, when you retire, you need to turn your asset into a guaranteed source of income to at least cover your basic expenses, and you could do that through different things, whether it be guaranteed annuities, or whether it be investment options that gives you not guaranteed but near guaranteed dividends, or other things that's going to give you regular income.
Okay. So would Medicare be included in their Social Security benefits?
So Medicare Part A is included. Medicare Part A, once you reach 65, you're automatically enrolled in that, whether you are retired or not retired. Now, Part B is not automatically included. And so, Part B, if you're enrolled with Part B, that will be deducted from your Social Security benefit. Part D, which covers prescription drugs, if you enroll in Part D, that will be deducted from your Social Security benefit. And let's say if you want Medigap coverage, and this is the thing that insurance that covers that 20% that the Medicare doesn't cover, that's you're going to have to pay out of pocket. So
Mm,
part A is included. None of the other parts are included. So you want to take into account with that when you're budgeting. Okay, how much income do you have coming into um, in retirement? You want to take into account that the Medicare is going to take away from that income as well.
Okay. So in case they own a home, right? Should their home be paid off or should they maintain their mortgage for tax purposes?
Yeah. So ideally, if all things being equal, I think the least amount of debt you have in retirement, the better. I'm not going to have a mortgage exclusively for the tax break, but it doesn't hurt. So if you can go into retirement without a mortgage, I say that's the best bet. But there are benefits for having a mortgage, which is the tax break, deductions that you're able to get. That being said, deductions comes and it goes. And we've seen that recently where tax laws changes and we lost some of our deductions, especially in the state of Maryland. And so you do not want to rely on things that you don't control. And so when it comes to finance, I like to take all the variables possible off the table because the least amount of variables you have, the more certainty you have with your projected future.
Okay. So obviously, my viewers watch, and most of them may be Ghanaians and be interested in retiring back home.
Mhm.
So what is your recommendation for that? Can folks retire outside of the US and is it a good thing to do?
Yeah. So I think personally, I think it's a great thing to do because most times when you're retiring outside of the US, your money actually goes a lot further. And so your retirement savings is able to last longer and you're able to do more things with it. Now, the easiest way to facilitate this is to keep a US based bank, okay, that hopefully you'll have access to in the country you plan on retiring. So whether that be Ghana, whether that be Jamaica or somewhere else, if you have a U.S. based bank account where your Social Security can come in, other income sources could come in, and you could also have bills set to be paid from. Then that allows you to retire outside of the country, where again your retirement savings could possibly go a lot farther than it would if you were to retire here in the US.
Okay. So
But
I
that's
know
a
we
great question.
so I know we spoke about life insurance. So for someone who is retiring, what
Mhm.
type of life insurance should they carry?
So the main thing for life insurance once you're retiring, because typically once you're retiring, you do not have dependents, right? Your children are maybe grown. You may or may not have a mortgage, so you may have zero debt and zero dependents. And so at that point, the major reason for life insurance is to simply provide to cover you if, God forbid, when that day comes, then, funeral expenses, everything will be covered by your life insurance policy. And that in itself doesn't require a lot of money. You may be talking 25, $30,000 of permanent coverage to cover, final expenses. And that's always good to have because it pays out quick, it's tax free, and your beneficiaries could get it eh, quickly if need be. Now, outside of that, let's say if you're somebody of means and you've grown assets, and if you were to pass, it would be a taxable event both from the assets that your beneficiaries will receive, also from property that your beneficiaries will receive, and you're concerned that they may or may not have the liquidity needed to take care of those taxes, right? Because you don't want them to have to necessarily sell immediately what they receive to pay the taxes. You want something else to be able to cover it. In that situation, life insurance also comes in because, again, it provides instant liquidity so that your beneficiaries could cover any taxes that may come about from your passing.
Okay. I know we are reaching our 8 p.m. time, but I have one last question, and I asked Dr. Eddie whether he has additional questions from our viewers as well. So, someone who's retiring, would you suggest they have a will or a trust, and why?
Yeah, great question. So you should definitely have a will. That's the absolute basic. You should definitely have a will, and in addition to a will, you should also have a medical directive that would allow somebody to make medical decisions for you if you are incapacitated and not able to make those medical decisions for yourself. in addition to that, you should also have a power of attorney, a financial power of attorney. So that way, again, if you're incapacitated, somebody will be able to pay your bills or cover your expenses or move money around or do the things that you would do if you were able to, but unfortunately, you're not able to. So, in addition to a will, you also need a power of attorney and you also need a medical directive in place. Now, depending on your situation, you may also want to have a trust in place, and depending on there's many different types of trust that do different things. But the trust could also help shield some of your assets from taxes or keep it out of probate or the courts. If something were to happen to you, it's an efficient way to transfer assets to your beneficiaries without having to go through the court process. But at minimum, you need a will, power of attorney, and medical directive. But great question.
Okay. Thank you. Thanks for your response. Okay, perfect. I was about to say, Dr. Eddie, do we have additional questions?
So
for
I think
today?
the last question, or the question from someone is, when can he or she retire, and when
Yes.
should that person take Social Security?
Yes, great question. So you could retire as soon as you have enough money to retire, but there's very important things to consider. The earliest you could take Social Security is at age 62, but it comes with some caveats. And those caveats are if you take Social Security at 62, if you have any other type of earned income, that Social Security benefit could be taxed. Okay. And that means you get to keep less of that Social Security. Now, depending on your date of birth, the Social Security will say, okay, your full retirement age is 66 or 66 in 6 months or 67. And at full retirement age, deemed by the Social Security Department, if you earn any income outside of Social Security, your Social Security benefit is not penalized. So it's ideal to wait till your quote unquote full retirement age because your Social Security benefit is not penalized and you will receive the full amount. Because if you receive Social Security earlier than 60 or full retirement age, not only is it penalized if you earn other income, but it's actually a lower dollar amount than what you would earn at full retirement age. That being said, everybody's situation is different, right? And if I have both parents died early, all my siblings died early, then what's the point of waiting? I don't want to wait till 67 to collect Social Security because I may not make it to 67. I want to collect it as soon as I can. And so if I'm in that situation, then even though I'm going to be penalized or I'm going to be not receive the full amount, I want it as early as possible. Now, a rule of thumb is typically the crossover point where it makes sense to wait for Social Security is if you live past 80, I think it's 81. If you live past 81, it's better to wait till you get full retirement age. If you die before 81, then you made out better collecting it early. But outside of Social Security, it depends on how much other assets you have in place, whether or not you're going to be able to retire early. And then this, I know we're running on time, but where are you going to get your insurance from? Because if you retire before 65, then you have to get private insurance because Medicare doesn't kick in yet. That's another very
That could be
important point.
costly as well.
You could be talking upwards of $1,000 a month just in healthcare costs.
Wow.
Okay.
Well, thank you, Mr. Hilton. This has been quite an interesting discussion. I'm surprised we didn't have a ton of questions, but I'm sure folks will be viewing this later because it stays on our platform for I don't know how long, but they'll have access to it. Exactly.
It's a lot of information to
It's
absorb.
a lot of information to absorb.
But if you have any additional questions, please email me. And then also I will provide my cell phone number, which is 703-953-6091. Feel free to give me a call or shoot me a text. I'm happy to answer any questions you have.
Okay, because I was going to ask what's the best way to reach you, but Dr. Eddie has your email.
Yeah, email is
as
the best
well to reach you. So thank you so much for accepting our invitation, and we hope to have you come back on a different topic as well.
Okay, thank you for having me.
Thank you.
Thank
All right.
you.
Have a good evening.
You too.
Bye-bye.
All right, bye.
Bye. That was good, Dr. Eddie.
Yeah, that was a
I'm
very
surprised
good
that
session.
we didn't have a lot of
Yeah,
questions.
because it was a lot of information, you know.
They can go back and take a look at this.
Yeah.
I learned a lot. Thank you so much. Okay. Great discussion. Okay. So people were there. See, I can't see that. So
The
I
people
don't
are
have
enjoying it. I
access
told
to
you.
it. And so
Yeah.
I'm glad that folks tune in to watch, and I hope that everyone
Mhm.
benefit from it. So because of time, I'm going to wrap up. So family, again, thank you for tuning into this segment, and we hope that you um, received a lot of information that could benefit you and your family. So Dr. Eddie and I will be back in April with new guests and all things related healthcare. So please, if you do have questions or concerns or suggestions, please email to emcuandyourhealth@gmail.com. We'd like to thank Mr. Jamal Hilton again for joining us this evening. And as always, we still in COVID, so please continue to stay safe, wear your mask, wash your hands, and social distance. And if it's your turn to vaccinate, please do so. I think that'll be the best thing for you and your family. We are trying, Dr. Eddie and I are trying to have a few of the church members who have been vaccinated to join us in April to speak about their experiences, what their concerns were, and hopefully encourage the rest of us who have not received our vaccines to go ahead and get vaccinated. So until then, please stay safe. Thank you again for participating and tuning into our program this evening. We hope that you have a very, very happy Easter. Have a good evening. Bye-bye.